All right, Mary, why don't we go ahead and get started? I think we might still have a couple more people logging in, but want to be respectful of people's time. So thank you so much for joining us today, Wednesday afternoon or evening. It's funny with daylight savings time, it's, at 6:30, it's pitch black outside, so that's a lovely change. But thank you for joining us for the TimeScale Financial Family and Friends webinar series. And today we are presenting Making the Most of Your Charitable Giving. So thank you for joining us. For those of you that don't know, I am your host today. My name is Joe Yoon. I am one of the relationship managers on the TimeScale Financial team. I'm actually the only TimeScale Financial member that is not based out of Boston. I'm originally from Lexington, Mass, but you are getting me from lovely Washington, D.C., because that is where me and my family are based out of. And I am happy to be joined today by my friend Mary Jovanovich. She is with Schwab Charitable and is one of their senior managers of business development when it comes to the Schwab Charitable offering. I've known Mary for, let's call it 5 years now, and she's worse off for it, but she deals with me, and that's a beautiful thing. So I'll take that as a win. And today's topic is, as we said, about charitable giving. And so I'm going to go ahead and give you a couple of did you know items about charitable giving. The first one might be a little bit interesting to you, that despite the pandemic, giving in 2020 rose above previous years. And this one is one that I know Mary knows. A lot of people, when they think of giving, they think, oh, a lot of giving is done by corporations. But as you see here, only 20% of donations to charitable organizations come from corporations, meaning that 80% come from individuals like you and me. And so that's why those individual gifts are the lifeblood of 501c3 organizations. I'm going to run through a couple more of these. I think I'll just bring them all up at once. And as you can see here, some demographic information in regards to what people are giving as high earners and what the average is. You'll see in 2020, the fourth one down, the average charitable donation by Americans is right around $750. And high net worth individuals are giving just under $30,000, but the rest of the general population comes in at about $2,500. Still pretty healthy numbers. Mary, do you have any other numbers that you want to add to this that you can think of off the top of your head? I know you have a fount of those numbers at your hands.
Yeah, I can say one of the things that I found most fascinating during the pandemic last year is our donors, the donations increased more than 50% as compared to the previous year. So if we looked at a statistic from 2019 versus the donations that went out in 2020, there was a 50% increase in donations to help people during the pandemic. So to me, there was a lot of concern and fear as a result of these nonprofits not being able to have their galas, that there would be some pullback in charitable donations, and donor advised funds really stepped up, and people with donor advised funds across the nation, not just at Schwab Charitable alone, stepped up and really helped out those nonprofits. So that's one of the most amazing statistics for me personally.
Awesome. And for those of you that don't know, donor advised funds are one of the vehicles that we'll be talking about tonight in regards to how you can facilitate your charitable giving. So we'll dive into that a little bit more in just a moment. But before we get there, let me go ahead and give you our discussion outline. And we've covered introductions. I've already said hi to Mary. I didn't give you a chance to say hi back, so I apologize about that.
Not a problem whatsoever. Hello, everyone.
And I'm about to go into what, if you're a TimeScale Financial client, you know this probably by heart, our empowered approach to financial planning and our 6 segments of financial planning. And then what you see is today we're going to talk about different vehicles. As mentioned, we will definitely talk about donor advised fund. We're going to talk about how to time your donations. We're going to talk about using the best assets for your donations, and how these things will then increase your giving satisfaction, will increase tax savings opportunities. And find, sort of at the end, Mary, with her deep expertise, will be able to provide some additional resources when it comes to charitable giving. So without further ado, let me go ahead and move us on to our financial planning framework. Again, if you are familiar with TimeScale Financial, then you know that we are very passionate about having an empowered approach to financial planning, and it all starts with your goals. And that is paramount. We want to know what your goals are, and we want to know how the plan we put together can help support those goals. And it breaks down into two phases for us. Phase one is coordinate and consolidate. Phase two is protect and conserve. When you talk about phase one, spending, it's simply put what we do every day. It's buying groceries, it's paying the mortgage, it is paying for new kids' clothes, which I had to do this morning. And what is left over, we then look into the other two buckets of savings and investing. So savings is when we have a known expense out there and money that's put aside for that, whether it be college planning or debt management, falls under that bucket. And then when it comes to investing, that's where we're looking to take money and put the appropriate amount of risk on it in order to help your money make money for you in order to reach your goals. So that's phase one in the coordinate and consolidate. When we look at phase number two of protect and conserve, here's where, this is at times not the fun stuff, but it needs to be done so that nothing comes along to torpedo all the hard work that you've done in phase number one. So the first bucket there, tax planning, we're actually sort of talking about that a little bit tonight, and wanting to pay Uncle Sam as efficiently as possible. When you look at the middle bucket of risk management, simply put, it's a fancy word for insurance. We want to make sure that you have the right insurances in place, health, life, etc., so that a disaster or something big doesn't come along and torpedo your plans. And then finally, when you look at the bottom right, we have estate planning, and that's where we want to make sure, again, we look at things in a tax efficient manner, and at the end of life are able to set up the legacy that you desire with all the hard work that you've done throughout your entire life. So all of these things surround your goals. And tonight, that's what puts together this comprehensive financial plan and really allows you to focus on making sure that those goals are met. And tonight, if you're on with us, one of those goals is probably about charitable giving. And we want to make sure that we are giving you the roadmap so that you can measure what matters to you when it comes to all of these segments. And tonight we'll be talking about charitable giving. So with that said, I'm going to go ahead and pass it over to my friend Mary Jovanovich so that she can start us off when it comes to the landscape of charitable giving strategies. So Mary, I'm going to go ahead and I'm going to pass the remote over to you. And so
Fantastic.
You should be able to drive the presentation forward from here.
So thank you so much, Joe. And again, thank you everyone for attending this evening. And when Joe reached out and said, Mary, I'd like to do a presentation, I was really excited because one of the things that's really important to me personally and professionally is to help people become economically independent and empowered with their wealth. And so this was a great opportunity for me to have this conversation with you this evening. So as Joe said, I'm a senior manager at Schwab Charitable. I'm located in Indianapolis, Indiana. I've been with Charles Schwab Company for close to 15 years. I've been in the role here at Schwab Charitable for the past 5.5 years, but more importantly, I've been in the nonprofit sector for over 25 years, serving in a variety of positions, whether it be on boards, fundraising committees, coordinating galas, events, conferences, things of that nature. So when it comes to charitable giving and the different solutions that are out there, that's an area of opportunity that I strive for. Let's see, there we go. Oh, I think I might have clicked it a little bit too quickly. So let's go ahead and get started and talk about charitable planning as an investment strategy. And what do I mean by that? Well, when you look at your life, typically there are 4 different times in your life that will trigger a charitable conversation. And the first one is annual giving. And I'm sure you're all getting ready because now that it's November, we know that Thanksgiving is coming. So there's always Black Friday, there's Small Business Saturday, Cyber Monday, and then the nonprofit world got together and said, you know what, we need Giving Tuesday. We need to remind people after having all of these purchases for a whole weekend that they need to remember that there are other people that don't have the ability to potentially make those purchases. So we have Giving Tuesday, and that's going to take place here on November 30th of this year. So you'll probably get that annual campaign from your local nonprofits to support that. Another opportunity is during a liquidity event, and that could be a multiple different types of liquidity events. Maybe you've held a concentrated position for a long time period, or maybe you've purchased a security and it's completely skyrocketed and it's performed extremely well. Well, if you go to sell that security, you would be facing capital gains tax. Well, one way to avoid the capital gains tax is to potentially use these different charitable vehicles that we're going to talk about this evening. Another event could be a major life transition. And that could be that you own a business, or you're selling a very large piece of real estate, or maybe you're getting to retire. Again, there's opportunities for you to plan ahead in order for you to maximize certain tax strategies to lower your future tax liability and be able to support those causes that you care about the most. And then finally, there's estate and legacy planning issues that we can talk about. So as with any investment strategies, there's always key strategies to think about as you're looking at your charitable planning. And the first is understanding the different giving vehicle options, and we'll go over that. The next, and this is where Joe can help you specifically, and TimeScale especially, and is utilizing the best asset to contribute to charity. There's some considerations for timing, and we'll go over some examples of what we mean by timing. And then obviously, when you start to do all of this and you realize that you're going to be able to give more money to these charities that you're passionate about, you're going to actually increase your giving satisfaction. And then, of course, we would want for you to not only engage with your investment advisor, but we would also want you to engage with your tax advisor as well. You want to have these conversations together so that everybody is on the same page and knowing what your goals are.
And Mary, just to put it out there, for those of you that are that partner with TimeScale in regards to your financial planning, that's a conversation that we want to be involved in regards to the conversation with your tax advisor. So please don't hesitate to loop your relationship manager into those discussions.
And it's really important to do that. I just want to echo that point and sort of like reinforce that idea of making sure that you involve Joe, especially for these conversations. It's really to make sure that you're utilizing everything to the maximum capacity possible and that the strategy is going to work to obtain your goals. And so that's why it's good to have these conversations. So selecting your, oops, I went one slide too far. Let me go back. Oh, Joe, there it goes, previous. There we go. Selecting your charitable giving vehicle. So when you look at charitable giving, we usually like to identify it into 3 separate buckets. Think of it that way. Or as someone else told me one day, Mary, why don't you call it purses? So you can think of it as your purse. You can think of it as buckets, however, whatever visual works best for you. So one of the things that you can do is that you can give directly. And again, we talked about Giving Tuesday. So you can give cash or checks or stock transfers directly to the charities of your choice. But there is the ability to give money over time and be a little bit more proactive with your giving and strategize using some of these tax strategies that are out there. And those are concepts that can be utilized with a donor advised fund, a private foundation, or at your local community foundation. Then there are some individuals who don't have the ability to give that money right now, but they still want to be philanthropically inclined. So what they're going to do is they're going to utilize their assets and give and earn income. And that can be done through charitable trust or charitable gift annuities. Now, we don't offer charitable gift annuities at Charles Schwab and Company or Schwab Charitable, but if you're working with a nonprofit and they wanted to establish a gift annuity program, again, reach back out to Joe, and there are some ways that we can get you connected to provide that at a local nonprofit that you might be working with.
And Mary, just so people I'm sorry, just so people understand with that last item that you had brought up, that's really the idea. You said, you know, that it's the idea of not giving up total control over that asset and putting it into either the annuity or the trust so that it generates income for the individual, with the idea that at the end of their lives, the asset then is given to the charitable organization, right?
That is correct. That is absolutely correct.
Perfect. Sorry to have
And
interrupted.
yeah, no. Please, I think it's great that we're going to have this conversation. And things that you think about could be things that our attendees are thinking about. So this is perfect. So let's go over understanding the different charitable vehicle options. The first, and probably what you know the most of, just because it's always in the news because of the Bill and Melinda Gates private foundation, are private foundations. Now, private foundations can be very beneficial to different individuals depending on their specific objectives. And so in some cases, what we'll do is we will have individuals who will set up a private foundation to support a specific scholarship. They want to really be hands-on, or they want to pay a loan, give loans to charities, or they want to have full legal control and administration responsibilities, paying a salary. One thing that is most people don't know, even though it says it's a private foundation, it is anything but private. It is very public, and it is out on the internet for anyone to see. So you could go and do a 990 search, just type in 990 search, and you can put in your zip code, and you can see everybody and anybody that has a account in your local area. And so with the private foundation. So that's something to keep in mind. And you do have to take a mandatory 5% distribution. Now with the community foundation, and I absolutely love community foundations, sometimes people will say, well, isn't the community foundation your competitor, Mary? And what I like to say is that, no, they're not my competitor. They are actually somebody who I can collaborate with. And so one of the things that to think about is with the community foundation, and why I would refer someone to the community foundation is that there's the possibility that they may need more assistance and hand-holding, and they need to create these mission statements, and they want to really understand how they can have an impact in their community. They want to know what the nonprofits are doing. They want tours of the nonprofits. All of those things I can't do. I can give information. Now, a charitable remainder trust, on the other hand, that gives you the ability where you can have some flexibility and the ability to generate a lifetime income stream. Now, there's a very strong formula that goes into this. It's a very complicated, I should say, formula that goes into what the deductibilities would be for that. And it does give you that flexibility, but it depends on how much you're willing to put into it, who's going to be a part of it, how long will it be, what the payout will be. That will all determine the deductions for the charitable operations. So let's go to the next one. Let's see, I hit the button. Let's see. Sometimes my cursor, I get a little nervous. If I hit it twice too quickly, it'll go forward. There we go. So a charitable gift annuity, Joe and I talked about that earlier. I won't spend too much time on this one. Again, it's an ability for you to eliminate capital gains tax and support a charity of your choice. And it does offer you an income stream. Keep in mind, though, that gift annuity is done directly with a nonprofit. So you're going to work maybe with like a St. Jude's to establish a gift annuity if that's something that you're interested in. Now, donor-advised fund accounts. Donor-advised fund accounts, that's the solution that we offer here at Schwab Charitable. A donor-advised fund account, think of that as a savings account, a charitable savings account. You're going to put the money into the donor-advised fund account. It is an irrevocable gift, meaning that you can't get it back to keep for yourself in the future. Once you put the money in, it has to go to charity at some point in time, but you decide when, where, and how much. It's going to give you the ability to give money to any qualified 501c3 at a significant less expensive price and less administration than a private foundation. And it's going to be, you don't have to do any additional tax filing like you would with the 990. So there's a lot of convenience with the donor advised fund because it's more affordable. And what I like to say is we're democratizing philanthropy because anyone can have a donor advised fund account. There's no minimum balance requirement. So you can open up a donor advised fund account for any dollar amount and still call it your own family foundation if you'd like. And all of these can work together or independently of each other. So for example, I have my donor advised fund account, and I'll send a grant to the local community foundation to be a part of the giving circle. Other people have private foundations, and maybe they want to make a donation to a charity that doesn't support their typical mission statement within their private foundation. The IRS will allow them to send money to a donor advised fund to then support that charity that they would like. Or God forbid, the family has experienced a loss and they don't know how to get the funds out before the end of the year, and that 5% is looming over their heads. It gives them the ability to have some more time to make decisions. So you can go from a private foundation to a donor advised fund. So there's an ability for all of these to work together or independent of each other, and all can engage future generations. So what is a donor advised fund account? Is it a financial planning tool? Is it an investment account? Or is it an alternative giving vehicle? Well, quite frankly, it's all three. So I'm going to talk a little bit about how the donor advised fund works, and then I'm going to turn it back over to Joe so that he can go into some more details about how he utilizes it with his clients. So as I stated, you can open up the donor advised fund account and you can title it whatever you'd like. And I really do like to spend a lot of time with the intention of the titling of the account, because that will help you enjoy giving. And so if you'd like to call this your family foundation, your charitable fund, your giving fund, you can use your surname in any capacity that you would like. I have other individuals, they want to remain a little bit more anonymous and they don't want to have their name utilized in the account. So they've called it the Give It All Away Fund, the Clever Girl Fund, the Share the Love Fund. Some people will use biblical verses. Some people will use poem titles. That choice is yours. So you're going to open up the account, you're going to give it a title, and then you can deposit any dollar amount that you would like. And ideally, you're going to put in an appreciated asset. And Joe's going to explain that here on the next slide. Once the money goes into the donor advised fund account, or the asset goes into the donor advised fund account, it's going to eliminate any capital gains tax associated with it. And if you itemize, it gives you the ability to take a charitable deduction. Once the money's into the donor advised fund account, typically that security is going to be liquidated, but then it can be invested. And again, we're going to talk about the different ways you can invest that money here in the next couple of slides. So the money can be invested and it grows tax-free. So all growth is tax-free. Once the money's in the account and invested, now comes the fun part. Again, you decide when, where, and how much, and grant minimums are only $50. Now, a common question that I get is, okay, Mary, I put the money into the donor advised fund account, but what happens if I die? What happens to the money then? Well, just like your other accounts, you have the ability to create a succession plan on the donor advised fund account. So you could identify other individuals, so family members or friends, close associates. They could be the successors on the account. They would take over the granting. They don't get to use the money personally. They have to give it to a 501c3. Or, like in my case, I don't have children, so our donor advised fund upon our death would be equally divided between our two favorite charities. There are other individuals who want to continue that legacy on and go into our legacy program, and instead of doing lump sum distributions to nonprofits, they create an income stream and might distribute 5% annually over the course of 10 years, or ideally in perpetuity. And so you have the ability to do that continuity legacy as well. So now what I'm going to do is I'm going to turn it over to Joe, and I'm going to allow him to talk a little bit about the tax advantages of contributing an appreciated asset.
Yeah, that definitely excited to talk about that. But before we get into it, Mary, I'm going to ask you to unmute for a second, and I want to just see if you can give a general lay of the land. You know, I think for the people we partner with, you might have picked up on the idea that the donor advised fund has a very low threshold in order to it's a low threshold tool for your charitable giving that will help in a multitude of ways. But when you talked about those other options, like the private foundation and the annuity and all those other options that came before the donor advised fund, what are sort of the ideal target for those options? And I can go back in slides so we can hit on them. So like a private foundation, like who should be considering this?
Yeah, so with the private foundation, I work with different attorneys that will say different things, but most attorneys won't even consider a private foundation for less than $1 million, just because of all the administration fees that go along with it and the reporting and all of that. And establishing the private foundation does require a legal document. So it is formed under a legal document. So because of that, most attorneys will say if it's under $1 million, we won't even do it. So they'll start at $1 million. I have other attorneys that will say 10 million, and I have another firm in Washington, D.C. that says 100 million, because most people are just giving money directly to a 501c3. And so they're saying if you're just going to be a grant making entity that's giving money to a 501c3 and you're not going to utilize it for these other features that the private foundation offers, then don't put yourself through the hassle and the cost of having that. Just go ahead and use a donor advised fund. So typically it's at the $1 million range. With the community foundation, community foundations are going to have minimums, and each community foundation is different. Typically, the lowest I've ever seen a community foundation to consider is $10,000 or more. Most commonly, I see $25,000 or $50,000 to start at the community foundation. And they will require that you keep that minimum balance throughout your history with them. So they never want the balance to fall below the $10,000 or below the $25,000. They want you to keep at least that much on hand with their accounts. That's not the same here at Schwab Charitable. Mm-hmm.
And Mary, when I think of community foundations, I think of that being organizations for people that want to give but don't necessarily know where to give, and
Yes.
and people that are looking to give more locally. So it's easy to say, hey, I want to give to the Red Cross or to St. Jude's or these large national organizations. But for people that are saying, hey, I really want to understand how I can make an impact around my neighborhood, that's typically when I think of a community foundation. Is that
Yes.
Is that the right thinking?
Yeah, and each community is different, and I can give you some really good examples of this. So, for example, in Indianapolis, Indiana, I was shocked to learn that our number one issue in the state of Indiana, especially in Indianapolis, Marion County, where I live, is we are second in the nation for attempted teenage suicide rates. So teenagers here in the state of Indiana, we're second in the nation. So 1 in 5 teenagers in the state of Indiana attempt suicide every year. It's mind-boggling to me. So I know that's why I give my money to the Giving Circle, because I want to support understanding how we can help our teenagers here in Marion County and get that statistic not to be 1 in 5. If I go to my neighboring home state where I was born and raised in Ohio, and I look at the Akron Community Foundation, they don't have any issues with teenage suicide. Their number one issue happens to be infant mortality. And so they are the highest in the nation for infant mortality and in actually globally as well. And it's all the result of the drug overuse in Akron, Ohio. And so it's the opioid crisis that's causing that infant mortality. So for individuals who really want to make a difference in their community, that's where they can find out where the problems are and what they're trying to solve for, where I can't do that at Schwab Charitable. I don't have the resources or the knowledge that a community foundation person would have about what's taking place in their backyard. So that's why when I say I love community foundations, I really do love community foundations. But I can use my donor advised fund to support the community foundation because I don't need all of the other services that they typically refer to as white glove service. I can utilize my donor advised fund account, support the community foundation without utilizing the other services that come with that at least 1% fee accommodation, where we would be 60 basis points. So that's the other thing is the difference in the cost. So private foundations are typically 2 to 5% annually. Community foundations are 1 to 1.25%, and a donor advised fund, depending on your balance, if we looked at $1 million, it would be 45 basis points. So you can see that which is less than 0.5%. So you could see that there's a big difference in the cost of these different charitable vehicles as well.
Got it. Perfect. So I'm going to bring us back to our tax example, which everyone always gets excited about. And when you look at this again, for people on the webinar tonight, obviously there's a heart of giving and wanting to impact mission, but there also the ability to save on taxes. So why not take both? And the example here is the idea of selling something 1,000 shares. That's where the top line is of $100,000. And this is something that you bought at $5,000, which means that you have $95,000 worth of capital gains. Now, I'm going to ask you to look at option 2 on the right-hand side because that's actually the cleaner thing to explain really quickly. So the idea here is if you were to take that stock and donate it directly to the charitable account, then 2 things happen for you. One, the charity gets the entire value of the stock, the $100,000, and all of that goes to the mission. And the second thing is, if you're in the 37% tax bracket, you now get to get a write-off, and so you get to reduce your income by $37,000. So that's the value of that charitable deduction to you. The option you see on the left-hand side is what people typically do, and that's what I think Mary and I are fighting against. And it's because they'll say, "Great, I'm going to take this $100,000. I want to give it to charity," and then they sell the stock. So just right there in selling the stock, they have to pay capital gains. And in this case, we're assuming that it is going to be 20% capital gains. So that's where instead of having $100,000 to give, that's where you see that bottom line of $81,000. And so now the charity loses out on $19,000. But the other thing that hits you is the fact that now instead of having a $37,000 deduction in your income with that tax bill on there, the capital gains tax that you're paying, plus the fact that now you're 37% of $81,000, it now means that really your charitable impact on your taxes is down to 11 grand. So you're trying to get the same thing done. Give the value of this stock to charity, and by using the right path, in this case, literally the right path, the option on the right, the charity gets more money and you get better tax savings versus what you see on the left, which is hurting both the charity and yourselves. And I should also say, if you have questions, there is a Q&A capability on the webinar, so feel free to put questions in there. Mary and I will look to answer those questions either in line or at the end of the presentation. And then with that, I'm going to move us to the next slide. Oops. Mary, I think I might need to take over control from you. So I'm going to go ahead and do that. And what I should say is I'm actually I'm a client of Schwab Charitable, and so I use them. I have my own donor advised fund for the Yoon family, and it is a fantastic platform. It's very easy to grant. You can do it on your cell phone. You can do it on your laptop. It's all organized for you. So at the end of the year, I can see all the granting that I've done, and then for the charity, it makes it really easy for them too, because they get this letter, and you see a sample of it right here, saying, "Hey, here's how much you're getting. Here's who it's from." You have the ability to, if you want to put your name or the acknowledgement, you can. You can also give it anonymously. There's flexibility there, and as you can see down at the bottom, you can talk about where you want those charitable dollars to go. So you have the ability to say, "Hey, I really want it to go where it's needed most, or to a specific project." And then the best thing for the charity is they get a check. So obviously, when it comes to cash and whatnot, that's about the same. But there's so many charities out there where when someone tries to give something other than cash, they struggle because they don't have the operational capability to do that. And so what you'll see here is, we talk about donating appreciated investments or assets to charity. And Mary, I'm going to have you come off mute because here are just some examples of what you can give. The different types of assets you can give. And again, the thought process here is it helps reduce capital gains, or not reduce, it takes those capital gains off the table in its entirety. Mm-hmm. And then when you use a platform like a donor advised fund like Schwab Charitable, you get all the resources of that platform and their ability to do things like assess real estate and like assess valuation of companies. If you are a business owner and you have interest in an S Corp or C Corp, I know Mary has tons of stories. One of my favorites from my time working with her was that someone donated half a hog. And so they donated half a hog and got a charitable deduction off of it. And Mary, maybe you can explain that one a little bit better, because I think it went to a university, if I recall correctly.
It did. And so it's very fascinating to me, some of the things, the donations that we will process. We always talk about publicly traded securities, but like this slide suggests, there's so many more things that we can take into a donor advised fund. And one of them happened to be a pig, a big pig. And so what ended up happening is it was a very valued pig. It had won state champion and was known for its DNA. And so there were some great things about this pig's genetics. And so what ended up happening is the Ohio State University actually purchased the pig through the donor advised fund so that the individual didn't have to have the capital gains tax associated with the pig. So who knew that farm animals had anything to do with capital gains? I didn't. But quarter horses, we've done a quarter horse. We've done a Maserati collection. Last year, I did gold bars, and the gold bars were in 13 different banks across the United States in the vaults. And as you know, with the pandemic, a lot of things were closed. So trying to get those gold bars proved to be very interesting to get those vaults opened up. So there's all kinds of things that we can do. Cryptocurrency is like the new fad thing to donate to a donor advised fund. So we can facilitate those types of transactions. So interest in the Vikings and the Diamondbacks, you name it, we've probably had some sort of donation related to that. And I think one of the, go ahead.
Oh, no, finish up, Mary.
I was just going to say one of the best things that we did, and this is one that I know Joe knows about, is sometimes somebody will come to us and say, we'd like to donate this, and we go through the due diligence and we realize it's actually not in the client's best interest to donate it to the donor advised fund. And that came about with the baseball collection. And so collectibles fall under something called related use. And so if they were to give us the baseball collection and we then in turn sold that baseball collection, the IRS states that that isn't a related use, and the donor would only be allowed to deduct it at cost basis. So we actually directed that donor back to the Baseball Hall of Fame and said, you really should work with them in regards to this incredible donation. It had Babe Ruth, so many things with Babe Ruth that they would want to take in. Because it's a baseball museum and because they're displaying the baseball cards, that's a related use. So now the donor was able to take fair market value. So there are some times you'll go through due diligence and there's no cost for the due diligence. It's simply a conversation. We would tell you like what the process would look like and if it's in your best interest. So that's the other pride that I have, is that sometimes we'll tell you, hey, this really isn't in your best interest to do it this way. This is a better alternative for you to achieve that goal.
Yeah, and the thing I was going to chime in about is, we recently, with one of the folks we partner with for financial planning, we did two farm parcels in Iowa. So it made it the ability to leverage again the facilities that Schwab has to donate these types of items that most people wouldn't necessarily think about. And for me, it gets back again to the mission and the fact that for most people, their purpose is that they want to do good with these assets. And by the way, if I can save on taxes, that much the better. So when you look at something like donating a parcel of real estate where the capital gains tax would have been pretty substantial, to be able to do that and fund your future donations. And this gets back to your comment earlier about timing. The beauty of a donor advised fund and some of these other structures is that you can put the money in today, but you can grant over years or over the rest of your lifetime. And so it doesn't put you in a position where you necessarily have to give all that money away all at once. So unless there's anything else, Mary, I'm gonna keep us moving forward because I know we have a number of more slides to cover and we're want to be respectful of time. So, and actually, I get to turn it back over to you for this section because we're talking about how the CARES Act and the 2017 Tax Cut and Jobs Act impacted charitable giving. So, Mary, why don't you speak to these two items really quickly?
Certainly. So, as you can recall, in December of 2017, under the Trump administration, they passed the Tax Cuts and Jobs Act. And what that did is it put some limitations or caps on certain deductions that you might have been able to take with an unlimited amount. Mortgage interest, for example, or your real estate, your property taxes, those have been capped at $10,000. They call it the SALT deductions. And so what happened with charitable giving is they actually didn't cap anything on charitable giving. They kept that in place, but then they also increased it. So for cash contributions, it went from 50% to 60%. And so what I mean is if you have an adjusted gross income of $100,000 and you gave $60,000 cash, you would be able to take off that full contribution. If you gave $70,000, $10,000 would carry forward 5 years. If you gave $50,000 of Apple stock, you'd be able to take $30,000 off your tax return and carry forward that $20,000. But if you did a combination of cash and security at $50,000, you'd be able to take that blended approach. But again, any excess would be carried forward 5 years. So that was a really good way for people who were impacted by those SALT caps from the Tax Cuts and Jobs Act 2017 law change. That was the ability for them to make up the difference, so to speak, by using charitable donations. Now this year, this came about in last year during the pandemic. Congress in the middle of summer extended it to take place until December 31st, 2021. Maybe you're like me and you do the standard deduction because all of these other deductions added up don't exceed married filing jointly is $25,100. So it doesn't exceed that. So I take the standard deduction. But my accountant has told me that it is my benefit to go ahead, since I sit on a board, to write a check for $600, give that to Dress for Success, because now my standard deduction is going to increase by $600. So instead of $25,100, it would be $25,700. It's an above the line deduction. And if you're an individual, it would be $300. So if you gave $300 cash. Now keep in mind that has to go to a public charity. And so it can't be a donor advised fund or a private foundation. It does have to be a public eligible charity, like a St. Jude's or maybe a religious affiliated organization. There's also this other provision, and this might be very useful if someone in the audience has done a Roth IRA conversion. There's the ability to give cash this year. And as you can see on the left side of the screen, it says 60% of adjusted gross income. That is true if you give that to a donor advised fund. But this year only, if you give money directly to a charity, and it's got to be cash or credit card. I don't suggest credit cards. Joe and I are totally against that because of the merchant service fees. They don't get the full amount. But if you give any dollar amount in cash to a charity, an eligible charity, you would be able to take 100% of that against your adjusted gross income. So, for example, your adjusted gross income is $250,000. If you write a check to charity for $250,000, you can eliminate your whole tax bill. Now, there's some good reasons to do that, and there's some reasons not to do that. And so if you have any questions about that, that's when you want to go back and have a conversation with your investment advisor, reach back out to TimeScale, and they'll be able to better assist you with that information.
Yeah, so when you look at this, really what we're seeing on the left-hand side, the advantage is the increase in some of the percentages as well as the 5-year carry forward from Tax Cut and Jobs Act. And on the right-hand side with the CARES Act, again, it's for people that are doing standard deduction. It means that you can still, if you give $300 or $600, depending on if you're single or married filing jointly, you can still go ahead and get some additional deduction by giving cash directly to a charity, as well as what Mary just spoke about, which is the fact that, that's for this year only.
Correct.
And same thing with the idea of the 100% ability to write off cash contributions to charity. That's, again, just for this year only.
Correct.
Cool. So let's push forward. So for those of you that are over 70 and a half and are looking at required minimum distributions, a very important tool for you if you are charitably inclined is the ability to do a qualified charitable distribution, or a QCD. And what that will do for you is it will allow you to give money directly out of your IRA to a charity that will count as your required minimum distribution, and it will not count as part of your income. So as an example, if your RMD is $20,000 for the year, in a normal year, you would take that money in, and then it would be additional income for which you'd have to pay taxes. But if you took that $20,000 and instead directly donated it out of your IRA to the qualified charity, then it still counts as your RMD, but now you don't need to add that $20,000 to your income for your tax bill. And as you can see here on the right-hand side, you can do that up to $100,000. And it really is a benefit for you. It's something that I actually do for my mother to make sure that when she gives to church, it just cuts down on her tax bill. And something that you can do, and please get in touch with us if you're interested in doing this, is we can set up a checkbook for you for your IRA account so that you can write checks directly out of your IRA to those charities. Just remember that checkbook is only for that purpose. You know, next thing you know, you go to the grocery store and you use that checkbook. That's going to be annoying for you. So that is an option for you to consider. And before I move on to the next thing, Mary and I are both, you saw us both cringe about the idea of using credit cards. It's because I think the statistic a couple years ago, and I'm sure it's been updated, but I haven't seen the number recently, but Mary, it's something like MasterCard and Visa get over $250 million a year from their processing fees for charitable donations. So
yeah, it's even higher now. Yeah.
Yeah, I can only imagine that it's gone up. And now you have charities having that little checkbox saying, oh, well, can you offset our processing fees? And that's fine. But again, it's still money that people are willing to give to charity that isn't going to charity. And so that's why we're huge fans of the idea of using checks, using donor advised funds, trying to find ways to get more dollars to mission for these charities. Another thing that I want to bring up is as a benefit of a donor advised fund is the term bunching, and you see it up at the top. So as Mary mentioned earlier, she and her husband are standard deduction people. And so the example that you're seeing here on the left-hand side is probably somewhat typical to their household, that in a year like 2020, they may have some deductions. They have $10,000 worth of giving. Between those two, the $13,000 of other deductions, let's call it mortgage interest, and the $10,000 in giving, it gets them to $23,000 worth of potential itemized deductions. But in 2020, the standard deduction was just under $25,000, which meant that they were taking the standard deduction. Again, this year, same $10,000 in charitable giving, same $13,000 in interest for their mortgage, getting them back to that same $23,000. And this year, the standard deduction has gone up because it is now has an inflation rating in it, and so now it's $25,100. So that means that for both years, Mary is taking the standard deduction and basically being able to deduct just under $50,000 off of their joint income. If you're charitably inclined, as you see here, by using a donor advised fund, it gets to what we were talking about earlier of timing. You have the ability, Mary could then, instead of giving $10,000 in 2020 and $10,000 in 2021, she could give $20,000 to her donor advised fund in 2020. She could still distribute $10,000 in 2020 to her charities and then $10,000 in 2021 to her charities. But what that will mean in 2020 is that she now has $20,000 worth of charitable deductions on top of her $13,000 of mortgage interest. And so that means in 2020, she has $33,000 of itemized deductions, which puts her above the standard deduction. So in 2020, she got $33,000 of write-off. In 2021, she gets back to just using the regular standard deduction of 25. And what you see then is down at the bottom, now her total deductions over the 2-year period is $58,100, which means that she gets to reduce her income by an additional $8,200 over that 2-year period. It's not changing a thing in regards to how much giving she's doing. It's not changing a thing in regards to when she's doing that giving. It's just using this strategy of bunching. And this is just for 2 years. Imagine if, I think, Mary, we know folks that do it for 4 and 5 years at a time. So they'll sit there and they'll put $50,000 or $40,000 in at once, and then do this over a 4-year period and reap the benefits of just additional tax deduction. Did I just describe your household, Mary? Is that what just happened?
Yeah, you basically did. And then the other thing to keep in mind is, if you remember back when Joe was showing that example of you invested $5,000 and it's grown to $100,000, keep in mind, ideally that $20,000 you're putting in, you've avoided all the capital gains tax on that as well. So not only is it the $8,200, but ideally it's $8,200 in addition to avoiding whatever the capital gains tax would have been on top of that. So that's where the popularity of donor advised funds have come from, and why they are growing so much, and why people are utilizing them as a charitable savings account.
Excellent. Yeah, I actually just did that for my donor advised fund this year. I took a mutual fund that my wife has been holding forever and was mainly gain. And I was like, oh, we're going to use it. And she's like, I don't want it anymore. I'm like, oh, we're going to use it to fund the donor advised fund.
So Joe, you just brought up a great point on that. So not only are you going to be utilizing it to, those appreciated assets that have gained so much in appreciation, but maybe you have this pain in your side and it's called a stock with no cost basis at all, and you have no idea how to get the cost basis and you just don't want to deal with it. So it's that little headache that you have. You can put that no cost basis stock into the donor advised fund because you're not paying capital gains tax on it. So you don't need the cost basis. All you need is the fair market value. So the value at the time of the donation, that's what your deduction is based on, fair market value. The IRS doesn't care about cost basis when you donate. So if you got that pesky little security in your account, and maybe it's back in the good old days when it was like Smuckers or Ma Bell, those are the common ones I see, and you have no idea what the cost basis is because of all the mergers and acquisitions, utilize that and put that into the donor advised fund and take that headache off your plate.
Yeah, without a doubt. So Mary, I get to kick it back over to you because we're talking about how to invest. So the funds that go into the donor advised fund, and I'll click us over to the investment options that Schwab offers as part of their pools. So please.
Yes. So there's 2 ways you can go about the investing. So we have our core account and then the professionally managed account. And the core account, there's 15 different investment pools that you can use. And for those of you who might want to align your investing with your values and you're looking for socially responsible mandates, the indication of the green leaf are those socially responsible mandates. So that's where you can align your investing with your values if you'd like to do that. And so you have the ability to use this core account. The other option that you have is that you have the option to work directly with TimeScale to have them professionally manage and create an allocation for you. So I won't go into more details than just simply there are 2 options out there: the core account with the 15 different investment pools, or to be professionally managed and create your own asset allocation, including publicly traded stocks, ETFs, mutual funds, bonds, certificate of deposits, things of that nature.
Yeah, and obviously we'd be thrilled to help manage the donor advised fund, and the idea of being able to manage an account sort of into perpetuity, because I have folks that I work with their donor advised funds, and the idea is, hey, and Mary mentioned this earlier tonight. Actually, I think one of my favorite stories is the one that you told of a woman who left a decent amount to the ASPCA but didn't want a building built, and so she set it up so that they got an amount each year, and it made her like a platinum sponsor every year for a long period of time after her death. because of the fact that the investing was put in place to continue to grow the fund going forward.
Yeah, and so that's the other thing that you can do is you can have donor intention. So the example that Joe had stated is she lived in California, single woman, no children. All of her other family members had passed away. So the bulk of her estate was going to go to charity. It was going to surpass over $10 million. And she wanted to leave it to a local animal shelter because she was very passionate about animals. And when she went to the nonprofit to tell them about it, the executive director said, "Oh my God, we can build a new building and name it in your name." And he started doing all this stuff with her money. And she's like, "No, that's not what I want you to do at all. This building is perfectly fine. You don't need a new building. What we need are, and she went through what she wanted them to do. So we went into a donor, a grant agreement with the Humane Society, and established how they needed to utilize those funds. And so they can only utilize the funds in that way. And then what gave her peace of mind is she said, no one's going to come and visit my grave, but I know at least once a year when they have the event and they recognize the donors on their website and in the programs, that I'll be remembered at least once a year. And so that gave her a lot of peace of mind as well. So that was a really good situation for me to assist in. Because it gave her happiness to know that she would be remembered long after her passing.
So Mary, before we wrap up here with the resources, one thing I just need to make sure I get this in when we talk about investment accounts. Schwab doesn't corner the market when it comes to socially responsible investments. We also have our portfolio options where we could do a socially responsible portfolio allocation for you as well. So just wanted to make sure I got that in.
And even more. So
yeah.
You have more options than we have. I only offer 3. So.
Hey, Mary, since we already I think we talked about a bunch of these.
We have.
Why don't we go ahead and skip the slide and why don't you go ahead and start speaking towards resources?
Yeah. So just resources really quickly, and then we'll open it up for a couple of questions if there are any. You can visit schwabcharitable.org for some more information on how to use the donor advised fund account itself. So if you wanted to learn a little bit more what it looks like, you can go there. Absolutely circle back with Joe to learn more information specifically about how you can utilize it for your own personal situation. But if you'd like to see how other donors are using their donor advised fund account, we have the donor stories out there, 20 stories in recognition of 20 years.
Well, that's excellent. And I think that brings us to the end of our presentation. Here, we're in a massively regulated
mandatory
industry, so,
yes.
Yeah, here are the lovely disclaimers from Schwab Charitable, and then again, I just want to thank everyone for coming out tonight, spending the time with us, spending the past hour to talk about the idea of charitable giving as being a goal and making sure that we're putting you in a position to measure what matters to you when it comes to that goal, in addition to doing some additional tax planning in the bottom left-hand corner. And so I'll go through the summary items really quickly. When considering charitable giving, and I'm going to go ahead and just load them all up at once, make sure that it's part of your financial plan. It's important because, again, for people that are desirous of doing charitable giving as part of your legacy, we want to make sure that we understand that that's something that you want to get done. And we also want to make sure we're doing the things that will put you in the best tax situation possible. When it comes to charitable giving, we talk about simplifying where you can. Mary, you and I didn't really get into a lot of this, but one of the benefits of using something like a donor advised fund is it consolidates everything in one area. So now instead of having a shoebox full of receipts and whatnot, and scraps of paper here and there about donations that you've given and check receipts, you can sit there and at the end of the year, I just get a printout. It's a report for all the stuff that I've given through my donor advised fund, and it makes it super simple to do all that recording and reporting. And when you see the final 2 items here, planning ahead makes it easier. It's about intention. It's about intention both for the charities that you want to support, but then again for the intention that you have for your legacy. And so that's something, just talking about the ASPCA, having those conversations in advance allowed for that donor to make sure that a building wasn't built in her honor, but instead pets were being taken care of and beds were being bought and, food was being purchased and, those sorts of things were happening. So, that's what our entire industry is about in terms of making sure that you do good planning. So to that end, please leverage the resources that you have. You might have some resources through your employer, and then obviously leverage us. And in turn, we leverage Mary and the resources that Schwab brings to the table for these types of conversations. I've put us to questions. I'm actually going to bring us to our lovely disclosures, because again, we know that's the reason why you came, was for disclosures. And again, thank you. I'm not seeing any questions having come in. So Mary, either we explained everything perfectly, or we just gave them so much information they need to think about it before they ask questions, and that's fine. If you do have questions after the fact, don't hesitate to get in touch with your relationship manager, and we're happy to answer whatever questions you might have. So with that said, thank you so much again. Hope all of you have a lovely evening and a fantastic, we're coming into the holidays. So especially as you look at Thanksgiving, this seemed like a very apropos topic. And we hope that you have a wonderful end to the year. So thanks so much.
Thank you, everyone. And thank you, Joe, especially.
Of course.